right? So what is financial accounting? Financial accounting, so that what we are learning here, it is information system which record the business activities. So for decision makers outside the entity, so basically this is the accounting that is made with the purpose for investors, creditors, government agencies, and for the public. So it means the accounting information that we prepare or accounting reports that we prepare in financial accounting, that is made with a specific mindset, mostly for outside entities, right? Managerial accounting, the accounting which belongs to or which is, uh, we prepare reports or we prepare accounting information for insiders, for example managers. So look at the name, managerial accounting, right? So why we need to have another separate accounting when we have financial accounting here? Because not every information is for public. So there are some trade secrets, there are some, like, so in financial accounting you can say that okay, our salaries are 2 million, but you cannot write down the name of every employee so that the other competitors can hunt your managers and your workers to and drive them to your competitor's company by offering them more salaries. So sometimes the information is key, so you cannot uh, publish to the public. Plus, businesses, they don't advertise their forecasting and their growth of the business for their future plans, right? So in sorry, in managerial accounting, the information is presented in a way that is used or that is for specifically for insiders like managers, those who run the company, right? Now organizing a business, so I'm just going to go through here a little bit quick because I think you already studied here, studied this topic in introduction to business. So there are various forms of business. So mostly there are three, but we do have one more addition, that is LLC. So we do have proprietorship, in which we have one proprietor or one owner. Partnership, in which we have two or more owners. LLC, which is limited liability company, in which there are members who basically initiate a company, right? And corporation, the members or owners are called stockholders, right? Like the public company, you can buy shares from the market. So why we have a different kinds of business form here? Because of liability issue. So in proprietorship, personal liability is to be guaranteed. It means proprietor is personally liable. What does it mean? It means if the business make a loss, it means owner make a loss. And loss should be fulfilled from owner's personal property. If I have a hair salon, right, and I have a loss, so my personal property, my belongings, my watch, my expensive mobile phone, my bike, my car, my home is to be sold to cover the loss. Okay? And then partnership, so in which there are more than one partners or owners who initiate the company, and general partners are personally liable. It means loss. If business make a loss, it means every partner make a loss. But we have different variety of partnership, and that is limited partners are not. So if one partner, for example, you ask a person to invest in your company and become a partner, so you can say that, look, I don't know about anything about this business. I can give you the money. I would be sharing the profit. But remember, if there is a loss cannot be transferred to my personal property. For example, I'm a doctor. and you are investment banker, you don't know about anything about the doctor stuff, because I'm a surgeon, I know heart surgery and all the stuff, but you don't know. If some celebrity came to me and I was doing some plastic surgery and what happened, it went wrong and I have a bad image and a business closed down or business make a loss, something, but that loss should not be transferred to you, because you already signed a contract that if anything happened, my personal property should not be involved. Otherwise, general partners are liable. If you do not sign this kind of agreement, then that loss must be shared by you as well, from your personal property as well, from your bank account as well, right? So that is the biggest drawback of partnership. So in order to cover that drawback, because sometimes what happens, mistake of one partner can cost the other partner as well. The other partner will say that, okay, I did my best, I was making this partnership to this, to the sky, and because of one person negligence, we have a loss, and I have to sell my own house and my properties and all this stuff. So why don't we establish LLC, limited liability company? It's like a partnership, but this partnership is like that. It is set up as a company. So in partnership, if one partnership partner resign, partnership dissolve. If I say, okay, Jamal and Suleiman company, if Suleiman resign, I cannot use the company name Jamal and Suleiman. Or I cannot use the company name. If Isaac come and Suleiman retires, I cannot change my company as Jamal and Isaac. It means I need to file again the taxation and regulation again to set up my own partnership. But in LLC case, since you already established a company, you don't need to worry about if some members say that, some partners say that, we don't want to do anything with you, just give me my share, I want to go. So in that case, the company remains the same, name remains the same, and only thing is that the ownership can be transferred and traded as well. And the one other advantage is that the members are not personally liable. If company make a loss, it means company make a loss. I didn't make a loss. My property should not be involved. Similar with the corporation, you already know that the shareholders or the owners of the company are called shareholders. Similarly, shareholders are also not liable. Right? It means if a company make a loss, if iPhone make a loss, and I am the shareholder of iPhone, so I don't have to sell my property and my bike and everything to cover the Apple company loss. Right? So we do have the other, you can say that explanation here. So I'm just go through a little bit faster here. So first, organizing a business is the proprietorship. It means it has a single owner. Here we go. Single owner tend to be small retail stores or solo providers, right? So normally those qualities which cannot be replicated, for example, singers, their voice cannot be replicated, right? It means business dies when partner dies. That's it. Right? If an author is writing a book, he's a proprietor. So nobody else can complete the book with his thinking. If a hair salon person, he can cut the hairs, so he has his own professional skills, right? So that's why mostly the proprietorship is set up as a sole provider of those services which are unique and which are of professional caliber. So proprietor is personally liable, like I said. Similarly, the business record should not include the proprietor's personal finances. So in accounting, it doesn't mean that, okay, I need to buy a ring for my wife. So I write it down on my hair salon register. Okay, I take out the money from the hair salon and I buy a ring for my girlfriend or for my wife. Okay, no. So that is your personal finances, right? Accounting should be done differently. But if business make a loss, you need to cover from your personal property. Okay, next one is the partnership in which two or more parties, and these are called partners or co-owners. So income and losses flow through the partners. What does it mean? Even if the loss is cannot be fulfilled from one partner, for example, if I made a partnership and company made a loss of 100 million, right? There are three partners. Let me write it down here. Three partners. So partner one have a property 50 million, partner two have a property 10 million, partner three has a property of 80 million. Company made a loss of 100 million divided by 3. So it means everybody must share $33 million loss. So partner A can bear the loss. Yes, he paid 33 million. His loss is covered. Can partner B pay the loss? Loss is 33 million. He cannot pay that. So how much he can pay? 10 million. Rest is 23 million. 80 million is the wealth of partner C. He can pay, yes. So it means this 23 also be shared by partner A and partner C. So losses flow through the partners. Even though they covered their own loss position, even then the total loss is not covered. Their further properties are involved to cover the loss. So that is the tricky point here. Everybody understand that? Right? Good, 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 good. So general partners have mutual agency and unlimited liability. So there are general partners and there is limited liability partners. If you allow one more partner and he say that I don't want to be sharing this unlimited liability, so I need to write down a limited liability clause so that my personal property is not involved, so I will be less riskier. Of course, your profit share would be smaller because those who assume more risk will be given more return. High risk, high return, right? So limited liability company, here we go. So business is liable for the company's debt, only business. So in this case, when you set up a company is different. Let me